I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi, I'm JB. In this video, we're going to take a look how we can value a company and determine what price we want to pay for the stock today, or what price we would want to pay for the entire company. There's a lot of different ways to determine a company's value and if it's a buy or not. And I assume you already found these great companies and with products and services the customers need or want. And of course, the company will have to check all the boxes you have in your checklist for a company you would like to own a part of. I mean, my checklist is the following. The company must have products and services customers want or need. The company should have a nice growth, innovation. They should have a competitive advantage over competitors or new companies trying to compete, usually through pricing power, high degree of innovation, or it could be high cost of competition to compete, for instance, building an infrastructure. They need to have good management with long-term plans, not just quarter by quarter. And these are my basic checks for a company that I want to look into and maybe invest in the long term. Okay, back to the task at hand. How do we value a company? Well, we need to understand the basics first. What is it we're looking for? We need to find out what a business could be worth in the future and then discount it back to today, so we know if the price we're supposed to pay today, is this a fair price or is it too high? And the only way of knowing this is calculate the future value and discount it back till today. So how are we going to do this? Well, we're going to look at a fairly simple way to calculate the value and thus determining what the stock price will be in the future and what it could be today. First, we should hear how the GOAT, the greatest of all times, Warren Buffett, tells us how he values a company and how he sees it. And afterwards, I will do some examples and see how we can use this fairly simple and get a pretty good idea of what a company and a stock is worth.
Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments. It says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change. But the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And What you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You know, you can gamble in the stock if you want to.
Well, as Warren Buffett just said, think of a company as an entity that operates to make money, and this entity needs money to expand and grow and become more profitable. You provide some of that money when buying a stock in the company. You buy a piece of the company, and for that, you expect to be compensated for taking on that risk and them using your money. There are numerous ways to value a company. I like to use the discounted cash flow method, as it's fairly easy, and it's a quick way to make a quick calculation of a company if it's overvalued or undervalued. Yes, it's not perfect, and the numbers is pretty much guesswork a long way. But still, if you use the numbers and you think a little and don't go into crazy growth values, well, it's going to be a pretty accurate way. The free cash flow is their company's operating cash flow minus their capital expenditures. It tells us as investors how much the company has left over to expand the business or return to shareholders after paying dividends, buying back stocks, or paying off debt. If I buy a part of the company, I would expect to be paid for letting them use my money. So I want to at least do better than the S&P 500, which is around 10% compounded annual growth in the last 28 years. And a quick note here, the last couple of years have been crazy, so maybe you should consider 8% as the benchmark. A company is a machine that earns money, and we want to know what the future value of this company is, so we can divide that value with the number of shares to get the share price in the future. And here we are using the discounted cash flow method. Let's say we have a 10-year timeline, and in 10 years we want to sell the company. What would the company be worth then? We find the expected growth rate and project that into the future, discount it back to the price today. Just like Warren Buffett said, we need to figure out if we're paying a fair price or we're overpaying for this company or farm or whatever it could be. If the market capitalization is higher than the intrinsic value, well, then the company is overvalued. If the market cap is lower than intrinsic value, then it's undervalued. This will make a lot more sense in a minute when I go through some examples, so bear with me. Now we need to find out how this DCF calculation actually works. When I look at it, it looks very complicated. But hey, let's dive into it and look. It's actually fairly simple. 1. We need to establish our timeline. Here it's 10 years. I find that 10 years is a good number of years, and I'm a long-term investor. And further out than 10 years, it's pretty hard to predict. So 5 to 10 years is usually the way to go. Then we need to find out what is the free cash flow of the company. You can find that on the investor relations page, use Yahoo Finance or some other places like Macro Trends and all around the places. I usually start with the company investor relations page and then I use that, but I also just double check the numbers other places too. Well, 3. Determine how much do we expect it to grow every year in the first 5 years, then the next 5 years. I start by looking at the growth history of the company, read their annual report. Usually they will write their expected growth rate, and then I use some common sense. I mean, don't take their word for it. If they're saying they're going to grow 50% the next 10 years, I don't think so. The only exception here is, of course, Tesla. And please be aware that don't go into extreme growth rates. Keep it realistic because the numbers really change with the growth rate. So be careful. Then you add your discount rate. Here I use my expected return. I would like to have at least 10%. You could go lower, you could go 8, whatever you want to, but just consider that the S&P 500 probably will return 7 to 8% over time. Then we add the terminal value. What's the company worth at the end of our timeline if we had it all and sold it all? And then we use the terminal multiple, the PE, to get the stock price. At the end, we can add a margin of safety to ensure we have a buffer if the growth is not what we expected. And if the growth is what we expected or better, well, then we get better returns. I use Sven Carlins' spreadsheet for this. It's a great piece of kit, and I'm happy that he made it, so I didn't have to. I have made some tweaks to it, I must say, but still, it's a good base. So, let's look at an example here. I have chosen Tesla, as it's one of my largest positions. And I've been out on the old interweb, finding some information. The top one here is pulled directly into Excel using the stock function. And the free cash flow I found on their website, and looking at both the investor relations page, and I also looked a little at Yahoo Finance and macro trends, just to be sure that I have the correct numbers. Same goes for earnings per share. Also found those places. And actually you could do your own calculations here, but this is just so much easier and it doesn't have to be 100%. So I'm gonna stick with the numbers that everybody else uses. Looking at the revenue too, the reason I'm gathering those informations and looking at them is because I would like to see where are they headed, where's the trajectory. Are they increasing 10%, 30, 40, 50? How much traction do they have? What is their growth rate? That's what I'm looking for. I'm looking for an indication to verify the growth rate or the possible growth rate. Now that I've been out finding all the financial data, I actually made a little Excel sheet here. So I can see what are we looking at. Is the revenue growing? Is the profit growing? How is free cash flow doing? How is earnings per share going? Are we going the correct way? Are we going the way I would like to see for this company? Okay, so now I've pulled out the data, and the most important thing here, for me at least, is the free cash flow, because this is what I'm looking for here. Discounted free cash flow. How much money will this company make, and when can I expect to get my money back? And by that I can determine the value and what the stock price should be today. Okay, here we have our bull case. This is where we think it's possible, but it's in the really, really high end of possible. So our bull case here, we take the cash flow, it's taken from up here, the calculation. And then we go to the growth rate for the first 5 years. And here, I know Tesla is at present almost growing, the car production is almost growing 100% now. So if we go with 50, we're not very far off. Elon himself has said that 50% is definitely possible, maybe even more, and the same from Zach. So let's put in 50. The next 10 years, how's the growth rate going to look the next 10 years? Well, we know there's at least one more factory in the making, maybe two. So I'm going to put in 45. And what is my discount rate? What will I discount the amount of money with? If you have $1,000 today, what could they be worth in 10 years? I could put them in an S&P 500. It is probable that I would get at least 8%, 7 to 8%. So going for a 10% discount, it's okay. I could put in 8, but I'm using 10. And what is the multiple for the company? Well, we could look at 25, but I still see Tesla as a tech company, so maybe even 30 here. I'm actually going to go for 30. Remember, this is the bull case. So now we entered the growth for the first 5 years, the next 5 to 10 years. We entered the discount rate. We entered the multiple. And now all we have to do is look back and see what would that amount of money be worth today, present value. So present value for one stock in this company would be $2,308, around $2,309. And right now we know that the price is around $838. So as looking at that, With the bull case, Tesla is a good deal. Okay, let's look at the normal case then. Well, I still believe in at least 50%, but let's just for the argument's sake say 40. 40% growth rate the first 5 years. And just to be a little pessimistic, I would say 30% growth years in 5 to 10 years. Actually, I will put that in 35. We need to be realistic here. 10% discount rate as before. And the multiple PE, I put at 25. It's a more realistic number. So now the stock price today would be almost $2,000. Still okay. But remember, all of this depends on a sustainable growth rate of 40 and 35% in the next 10 years. But that's why we have the bear case. We go to the bear case, we do exactly the same. And this time, we're really going to be bears. Tesla with a growth rate of 15%, it's stupid crazy. I can't see it happening. There has to be some kind of a major event for that to happen. But let's just keep at that. 15%. 10% discount rate, and a multiple of 20. Now we have a stock price of about 1,660. Now we're going to move down a little. What I have down here is the bull case, the probability of the bull case, and the value, what is the price. The same with the normal, the probability and the price. The bear case, probability and price. And we even those out. See, what is this going to be? What is this going to amount to? So this way we spread the risk across the three cases, just to be sure. And to be extra sure, we add a margin of safety. I've added 15%. Somebody may take 20%. You decide. Somebody may take 10%. I take 15. It's a good number. That gives us a safety price of $1,800 per share. And right now it's about 838. And remember, we're not talking bull case, normal case, bear case. We're talking spread even with these probabilities. If I have to give my own complete crazy bear case, I would go back here and I would say 50, yeah, maybe even 60% the next 5 years. So let's just go 60. And the next 5 to 10 years, I don't know. They're growing that fast. It's incredible. Let's go with 50. And the terminal multiple, yeah, this is a tech company. In 10 years, I'm going to put in 40. And if we then take the discount rate of the S&P, we're talking a stock price around $5,000. And actually, that's my price target for 2030. It's around 5,000. So that kind of tells you why I'm very, very heavy in Tesla. Tesla accounts for around 75% of my portfolio, my public portfolio. And I'm going to keep adding if it dips. Let's do another one. Here I've done Pepsi, the same as before. Pull the data from the Excel stock function. Amount of shares, market cap, what the high and lows were, what the price today is. I've gone to their investor relations, looking at the free cash flow, Yahoo Finance macro trends, the same with earnings per share. The same with revenue, and the same with their EBITDA. And if you look at Pepsi, they're not growing the way that Tesla is growing. It's kind of an up and down. So this is a lot more, difficult to project because it's not, I wouldn't say volatile, it's just so unpredictable. But let's do the same, the bull case. What would you think the growth rate would be for the next 5 years? Well, looking at the free cash flow, it's been minus since 2017. And first in 2020, it went up. So 18, 10, let's just say they can hold something in between for the next 10 years. So my bull case is going to be, okay, let's really go bull case, 15. And what is the next for the next 10 years? Well, they project themselves a 9% growth rate. I'm not sure about that, but this is a bull case, so let's stay there. Discount rate 10%, and the multiple today is around 30. So bull case, let's do 30. Now we get down to the normal case. Growth rate of 8%, yeah, it's probable. 5, yeah, also probable. 10 and 25, yes, also probable. Bear case, almost no growth. 3% the next 5 years, 0%, well, let's just put in 1 for the 5 to 10 years. And a multiple of 20. That's a real bear case. So, bull case, about $322. Normal case, $282. Bear case, $242. And just a reminder here, this is without the dividend. So there's an add-on bonus with the dividend every year. And with the probabilities for the bull, bear, and normal case, we end up with a price around $300 per share. And right now, Pepsi is trading around 166. So then you gotta have to ask yourself, is this a good buy or not? Well, when I look at Pepsi, which is stable, maybe growing the way they think, I would rather go for Tesla. But that's a difference in investing styles. Pepsi is a dividend king, so they're probably gonna be more stable, but their returns are not gonna be as high. That's just the way it works. And as I said, I put a link in the description for Sven Carlins' original sheet, so you don't have to do the whole thing over. And remember to watch his channel, he's got very good content too. So head on over and check it out. It's a great tool to value a company and takes a lot of the hard work out of it for you. I hope you enjoyed the video and got some value, and remember, it's a good idea and very much appreciated to hit a like button. I really, really like it. On that note, I will leave you and hope to see you in the next video. Bye!
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning. There ain't no point in resisting. Living